Okay, so this is a paper that has come out on the SSRN network. It's they asked the question here: manipulation in the VIX, and what they point to here is might take a quick view of the abstract. At the settlement time of VIX volatility index, volume spike on S&P 500 S&P index options, but only in out-of-the-money options that are used to calculate the VIX, and more so for options with higher and discontinuous influence in the VIX. We investigate alternative explanations of hedging and coordinated liquidity trading tests, including those utilizing different in put and call options, open interest around settlement, and a similar volatility contract with an entirely different settlement procedure in Europe are inconsistent with these explanations, but consistent with a market manipulation hypothesis. Okay, so they developed the paper. They have very interesting evidence. They have very strong evidence to suggest that the market's been manipulated. In particular, what they're pointing to, if we take a look at the Arnold and Earl Excel spreadsheet, if we just use this for a moment to kind of illustrate a little bit what they're saying, when the VIX is being estimated, right, when we implement this formula here, right, the VIX formula for estimating, well, this is for the variance, and then we interpolate to get the sigma, to get the standard deviation. When we estimate this term, it's only the out of the money options that we use. Okay, so when we look at the data here in terms of options, now this data is too simplified. This is a simplified example that was presented by the CBOE in 2003. A more realistic set of option prices, option chain data that might be addressed is the 2014 and the 2018 example. So you can see that for any particular VIX estimation, there are more than 10 or 15 relevant data points. There is a substantial number, maybe of the order of 150, 160 data points are being used in the estimation in terms of the option chain data, not as might be suggested here that there's only 10 or so. Okay, so many data points are being used. Only the out-of-the-money options are relevant for the estimation of the VIX itself. Okay, so only the out-of-the-money options. When we do our interpolation, this VIX figure is dependent on a large number. So we would have a much bigger sample. This would be more representative of the type of sample that we would have. The gray area out of the money. Now, when we look at the value of options, the data that we take out of the money option values, but the out of the money options, when we're close to the money or at the money, which would be around this 900 strike level, the effect, the contribution of, in terms of the estimation, when we work out the sigma, the value that we obtain here for the sigma squared 1 and also sigma squared 2 is coming from this sum, right? And each of these figures here are estimated using this term, right? If we take a look, though, we can see that the contribution of the options that are closer to the money or at the money, right, is greater. So this is, we would have 1, 2, 3 zeros, whereas with this number here, if we expressed it in not scientific notation, in a standard format, we would have 5 zeros, so it would be 0.000000458. So its contribution is much smaller, right? Maybe 100 if we for instance take this value here, the at the money, and divide it by the out of the money, the more out of the money option, whether it's a put or a call, you can see that this is, these figures here are, or this figure here is 122 times bigger than these figures here. Okay, the more peripheral figures. Griffin and Sham would say that it's more likely when the manipulation takes place, the manipulation, because the VIX market is very big, traders would most likely try to manipulate the market by going into the more out of the money options, where there's greater bid-ask spread and where a small number of transactions would distort or skew the value of the VIX. Okay, so if you can home in on this sector, yes, it's true, there's not that many options, right? The amount of interest, open interest in contracts, and the amount of trading that's taking place in these deep out of the money options, right? Whether they're calls or whether they're puts, in the deep out of the money segment of the market on the S&P 500 options. Yes, some trading will affect values here, will drive up the value, the bid and the ask. You can change relatively easily the bid and the ask prices by engaging in trades close to the auction dates, right, that determine or go as inputs into estimating the VIX. The CBOE would maintain that in the design of their VIX index, the process should be relatively robust, even if you manipulate, right, these out of the money, deep out of the money calls and puts, right. The impact should be small, right, because the contribution here of these deep out of the money options is relatively insignificant or trivial relative to where the main liquidity is. And these options here, where the vast amount of trading is going on, where the market is hugely more liquid, where there's a lot more volume in terms of trading and open interest, these options are difficult to manipulate. Okay, now if we take a look at the article, however, is a very powerful article. So the article by Griffin and Shams has colored a lot of the thinking amongst market participants and has garnered a lot of attention in the media. In particular, I took a look recently at there's a VIX index, the Financial Times. Let's see if we can find the date here for this particular article. This is April 18th, 2018. And they summarize a little bit the detail, but the main point is that the VIX index, a measure of market volatility, nicknamed Wall Street's fear gauge, surged more than 10% in the space of a few minutes on Wednesday morning, around the time of a monthly auction that sets the price of derivatives tied to the index. Okay, and what they're pointing to is this period here, in April 18th, right, the VIX went from below, just above, slightly above 15 up to close to 17. Okay, and then that leads to the question that a large move in the VIX comes at a time of increased attention on the index, which is implicated in February's equity market turmoil and has been hit with multiple claims of manipulation. Okay, so Griffith's and Shams' article is having an influence on the thinking here. We can see how that the last year, two University of Texas academics also claimed that the index has been manipulated. They focused on auction settlement process and the apparent appearance of large offers to buy and sell out of the money options that affect the VIX value. It is this type of activity that traders and analysts say appeared to occur during Wednesday's auction. The VIX moved from just 15 to over 17 in over the space of 30 minutes. So this is the more recent. This is April 2018. The article was written in 2017. It's been cited as being an example similar to what Griffin and Shams set out as a hypothesis in their paper. The number of bets on a rising VIX are at record levels. The most recent data from the Commodity Futures Trading Commission show non-commercial accounts, a proxy for fund managers, had a record of a net long position in VIX futures for the week and April 10 of 92,913 contracts. So it's coloring the thinking. You can definitely see in terms of the media, there is a response here. Also in terms of, I had a look also at, I think it's Wikipedia or Investopedia. Is someone manipulating the VIX? And when we come down to, again, this here is, let me take a look, 2016, 2017, and then we're in February 2018, and again there's a very dramatic increase in the VIX there. But they Investopedia here in this article, there's the manipulation according to, again maybe we should start here. Allegations have long circulated. Some traders have had their fingers on the VIX scale. On February 12th, following the market turmoil, Jason Zuckerman, Matt Stock of Zuckerman Law, a K Street firm, wrote to the Enforcement Division of two financial regulators, the Securities and Exchange Commission and the Commodity Futures Trading Commission. The letter laid out allegations of rampant manipulation of the VIX index on behalf of anonymous whistleblower who held senior positions at some of the large investment firms. So the legal world, right? Lawyers are taking an interest in this. And there's a blog here I took note as well, and they in the blog here addressing this, the VIX is fixed, they preview the tricks. Okay, a new year, a new manipulation to monitor. Today's subject is none other than fixing the VIX. It's time for a trip back in time, not very far back though, just 23rd of May 2017, the date on which John Griffin and Amin Shams published Manipulation of the VIX. 37-page reference, extensively researched paper on manipulation, Chicago. Options volatility index. VIX is widely tracked index that gauges 30-day implied volatility. And while Griffin and Shams couldn't muster up a particularly exciting title for their own paper, the VIX itself is often referred to as the fear index. But what are the impacts here? Well, as the litigation-minded among you expect, this publication set off more than a few alarm bells and had in-house counsel calling their lawyers. Between March and July of 2018, more than 28 VIX manipulation actions were filed. They now have been MDL'd to Judge Manish Shah of the Northern District of Illinois as in Chicago Board Options Exchange Volatility Index Manipulation Antitrust Litigation. So the consequences of this paper has been very powerful in terms of influencing the actions of many actors, in particular and of note in the legal community. Okay, and the final part here, I suppose, is that the CBOE is now trying to defend itself. What might it, what potentially is the defense here for the CBOE? And their defense would largely come from this idea that deep out of the money options, even if you can manipulate them, the impacts would be more trivial. And as a consequence consequence, the CBOE would say the VIX index would be very robust to manipulation.